As financial analysts, we need to understand the motivations that company management might have to present low quality financial information or low quality financial reports. If the motivations exist, then we need to understand what sorts of conditions are conducive to issuing low quality financial reports. And finally, we as analysts need to be aware of the mechanisms that discipline financial reporting quality. Let's start with motivations. One of the major motivations for company management to present low quality information is to hide poor performance. Let's say that the company is facing difficult economic times and the company believes that these difficult economic times are just temporary. What management might do is some form of earnings management in this particular period with the thought that the numbers will then improve in the future anyway. So simplistically, hiding poor performance is one motivation for presenting low quality financial reports. Another important one is to meet or exceed earnings expectations. This is particularly important for listed companies, where companies that are followed by investors or analysts will generally have an expected earnings number. So analysts will have their expectations about the earnings number for a particular quarter, and if it turns out that the reported earnings fall below those expectations, then generally the stock price will take a hit. Management knows what those expectations are, and in order to meet or exceed those expectations, they might manipulate or manage the earnings. A related item is to meet or exceed prior year results or some other benchmark. I mention prior year results because very often numbers are compared with the same number in the previous year or the same number in the previous comparable quarter. As an example, for let's say a company in a cyclic business, the earnings number for the fourth quarter in 2013 will be compared with earnings in the fourth quarter of 2012. Management knows that their reported earnings number here will be compared with the reported earnings number from the same quarter last year, and if there are certain expectations that this earnings number must exceed the earnings number from this quarter, management might try to manipulate the earnings. There might be career concerns and incentive compensation. So let's take career concerns first. Senior management would like the world to believe that the companies that they are managing are performing well. Let's take this one step further. Let's say that the CFO of a company is planning to look for employment at another firm. Obviously, what the CFO would like is to present good performance numbers at the company where he currently is, because this will help with his negotiation position at the next company. A related point is incentive compensation, where senior managers are often compensated based on the earnings numbers. So there is inherently a motivation to present high earnings numbers so that the bonuses are higher. Next, we move into conditions conducive to issuing low quality financial reports. Broadly speaking, there are three conditions which, if they exist, then the probability of low quality financial reports is very high. And the three conditions are shown here. One is motivation that we discussed on the previous slide. Another is the opportunity to present low quality reports. And the third is rationalization. Let's discuss opportunity in a little more detail. Let's say that at a given company, the internal controls are weak. In other words, the CFO can find it easy to manage earnings. Related to that is an ineffective board of directors. As we see in the readings on corporate governance, ideally the board of directors should be keeping track of the numbers that are being presented. Let's say that the board of directors is weak. Perhaps the board of directors is very closely aligned with the senior management, then that creates an opportunity to present low quality reports. If a company is operating in a region where the accounting standards allow a range of choices, then management might be tempted to use the standards that give numbers or produce earnings numbers that are relatively high or that meet what the managers want. Motivations we have talked about on the previous slide. And finally, rationalization. Those who are managing earnings will try to rationalize their behavior, and if a company is operating in an environment where it is relatively easy for managers to rationalize their behavior, there the probability of presenting low quality financial reports will be high. We now come to the mechanisms that discipline financial reporting quality. One of the mechanisms is the market itself. This is the market for raising financial capital. If a company is presenting low quality financial information, then the riskiness associated with that company will be high. In other words, investors will perceive this company to be high risk. If investors perceive this company to be high risk, they will value this company at a low level. In other words, the required return that investors will demand will be high. So this becomes very costly for companies. The cost of capital is high, and that is because the information being presented is low quality. So this in of itself serves as an incentive to present high quality financial information. But as we've discussed, there can be several conflicting incentives. So senior management might be more concerned with their compensation, so they would have an incentive to overstate earnings. Because of this, there is the need for regulatory authorities. In the United States, the regulatory authority is the Securities and Exchange Commission. And in fact, in every country where there are publicly listed companies and securities markets, there will be some regulatory authority. In India, for example, we have the Securities and Exchange Board of India. In Pakistan, we have SECP. In Hong Kong, we have the Securities and Futures Commission, and so on. Now, these regulatory authorities are members of an entity called the International Organization of Securities Commissions, or IOSCO. This is essentially an umbrella organization of the various regulators and also of other security market participants such as stock exchanges. But the IOSCO can also be thought of as the global standard setter for the securities sector. The actual regulation, though, will happen through the particular regulatory authority in each jurisdiction. So let's just take the SEC in the United States. The SEC is responsible for overseeing approximately 9,100 US public companies, along with investment advisors, brokers, dealers, and securities exchanges. According to the curriculum, in 2002, the SEC reported that it had filed 515 enforcement actions for financial reporting violations during the preceding 5-year period. It is important for you to recognize the typical features of a regulatory regime, and those are listed over here. The regulatory entity, such as the SEC, will generally have registration requirements. So publicly listed companies need to register, and there are certain registration requirements. Even private companies, which are private limited companies in certain countries, have registration requirements. There are disclosure requirements. Obviously, depending on whether the company is public or not, the disclosure requirements will vary. The disclosure requirements tend to be very high for listed companies. There are auditing requirements, so companies must be audited by an independent third-party auditor on a regular basis. Management is required to present a commentary on the performance of the company. There are responsibility statements. For example, in the United States, we have the Sarbanes-Oxley Act, And under this, senior management is required to submit formal certification that the information presented is reasonably accurate. And if this does not happen, or if information presented is not accurate, then the senior management is going to be charged with criminal offense. And if this does not happen, then senior management can go to jail. Regulatory review of filings. So the regulatory authority actually reviews the filings, and it's extremely important that there be some form of an enforcement mechanism. All these regulations will only work if there is a credible threat of enforcement. The role of auditors has been mentioned before, but it is important enough that it's being discussed again. Auditors provide third-party verification of financial statements. We've talked about auditors and the sorts of reports that they might present in other readings. Here, we just want to point out that even though an auditor gives a favorable view, that is not a guarantee that financial reporting quality is high. And we say this for several reasons. One reason is that the information that is reviewed by auditors is prepared and presented by the company. So the company gives information to the auditor, and the auditor is reviewing that information. It is conceivable that the company presents biased reports or biased numbers to the auditor. Another point is that audits are typically based on a sample, and the sample might not necessarily reveal what is going on with the overall company. A third point is that there might be an expectations gap between the auditor's role and the public's expectations of the auditors. An audit is not typically intended to detect fraud. It is intended to provide assurance that financial reports are fairly presented. And the fourth point is that companies being audited pay the auditor, and that might create a potential conflict of interest. The final point on the slide has to do with private contracting, and I'll use an example from before. Let's say that we have a company that needs money, and this gets a substantial amount of money from a bank. The bank is, in a sense, the private contractor. And let's say that when lending money, there is this legal agreement that allows the bank to monitor the financial reports of the company. This will create an incentive for the company to produce high quality financial reports.